I forgot that it's a different. I'm on a different side of Australia, so it's a different time zone. So I was a bit confused. So sorry about that. No, but seriously, apologies for my tardiness. Rob and I have a few announcements for you tonight, which I was just going over with dear Rob, and I could see a question that came through from JJ, which says, "Hi Rob, was that you on Ausbiz this week being interviewed for Selfwealth? Was that you, Rob?" Um, and then Rob says in the comments, JJ, depends which one you saw. After one, my PR agency recommended media training. Oh, okay. Well, it's a kind of a sour end to that update. But Rob, yeah, Rob is kind of famous. He's like finance famous, let's be honest. So I'm joined behind the keyboard by Rob tonight. So if you see the Selfwealth moniker, you know who that is. I'm over here in Perth this evening, about to go to dinner because I saved 2 hours. Just travel across the country and you get 2 more hours in your day. How good's that? And we have a few things for you tonight, which we're going to share, which may require you to use, that other side of your mouse, or I think it might be 2 fingers on some phones, or hold it down. That right click thing? We're going to need you to do that because I don't want you to leave the Selfwealth Live in order to enter a competition and potentially win some ETFs. So there's a special thing that I'm going to mention, and why don't I just jump straight to it rather than playing a bit coy? And I know many of you are here just for the disclaimer, so I will get that to you shortly. So in the chat, I'm going to say beta shares, core portfolio ETFs, and then put a link, and you'll see that there. So I'm going to open that up on my side. Now, if you click that link, it's like a bit.ly link, and it goes to this page, if I'm not mistaken, Rob. And in here, here's what you need to know. As long as you put your information in here, your email address, your first name, your last name, and describe in 50 words or less, in your view, what are the ingredients for a perfect portfolio? Let's go. Growth and dividend are my favorite. ETFs are wonderful. I don't know, because it's beta shares. Let's just put that in there. I'm going to put in an email address. I'm going to put in the generic Rask email address, and then I'm going to go Owen Rask. I know for sure this is not going to work out for me, but I'm going to do it anyway. And then I'm going to click submit. And thanks for entering. So once you enter, it's that simple. By the end of August, you need to have a Selfwealth account. All right, so that's obvious. You need to have a Selfwealth account in order to receive the ETFs. There's 3 prizes, each with $2,000. And that's about it. That's 1, 2, 3, and done. So put your stuff in, create a free account on Selfwealth, and that's it. Go in the draw to win. That's my announcement. So that's my exciting news for this week. Other than that, I hope you were happy with that one. But I'm going to go through where I'd invest some money right now. And I don't know if there were a few guesses coming through or not, but I did see a few things mentioned about small caps in the chat, which is a really interesting part of my investing experience, and where I spend probably most of my time today. Not today, but when I say today, generally, I mean my investing broadly. So that is a focus of tonight's session, but we're also going to cover some essentials, and I'm going to cover a few topics that you might not expect. So what I would really love for you to do is, as we go through each of these slides that I've got for you tonight, I would love for you to just ask me questions, because some of them are probably not what you think. Okay, let's get into it. So now that we've entered for the competition between with beta shares and Selfwealth, now we can go back to the slides. So I'll go right to the top. This week's joke, the best bit of the show potentially. My boss asked me why I only get sick on work days, and I said it must be my weakened immune system. That's my joke. From Dad Says Jokes on Twitter, also on Instagram, also wherever you get your jokes. Daily jokes, sometimes multiple jokes a day. If you are a dad or a mum, or just anyone who likes jokes, jump on there. Share them with your colleagues. Spread the love. Here's a very important message from Selfwealth. We need the hold music. Penny just said, I will have a tax bill. Have a guess what, Penny? Me too. I had a massive one last year, and this year I got a refund. Or I'm going to get a refund. So, I mean, it all works out in the wash, doesn't it? At the end of the day, some of us aren't so lucky some years, but sometimes we are. 7 out of 10 for the joke. So that's a pretty good one from you, Financial Freedom. I actually take that. So some people are reporting that it won't let you submit the form. Might just be me. And Rob's giving me a 6 out of 10. Well, Rob, that's the lowest score. So that's that. Joe Indy says, recommend 3 ETFs to buy for the next 10 years, dollar cost averaging. We could talk about that. We'll talk about that in a bit. Okay. So let's continue on to the next slide. Here's a photo of me with no legs. And in this, I'm going to zoom out just a touch. In this show, I'm going to deliver some not personalized, generalized information, and is definitely not personalized. I don't know your financial situation. For example, if you want to buy a hot dog truck and tour around Australia selling very good hot dogs, I don't know that. So even if I talk about an ETF, I don't know how that relates to your hot dog venture. So please keep in mind that any of the information that I do share tonight is strictly limited to general financial information only. The information does not take into account your needs, goals, or objectives, so you should not act on the information until you've spoken to your financial planner. I'm the founder and sole director of the Rask Group. We have an Australian company number, look at that wonderful thing, which is a corporate authorised representative, number 1280930 of Wattle Partners AFSL 383169. You can stick both of those numbers in the ASIC website, rather, and you can look up to see if the AFSL is current, what we can and can't say. You can also refer to the Rask Group's Financial Services Guide. A lot of people actually don't know that you can just take both of those numbers in there, the 1280930 and this one, and you can actually check if your financial planner is actually licensed. Almost all of this stuff that I hear in the media of people getting ripped off and scammed comes from people who pretend they have an AFSL or pretend they have a license, but they don't. The easy way to check is just to go to the ASIC website, asic.gov.au, or the moneysmart.gov.au website. The views expressed in the live streams are solely those of myself and or our guests. We don't have any guests tonight other than just us, and those views do not necessarily reflect the views or opinions of Selfwealth. Well, that's wonderful. Okay, so tonight we're going to go through a few things, but I imagine what we have is a bit of a mixed bag, bit of a box of favorites with us tonight. We've got some of you that are very experienced in investing and some of you that might be brand new. You might be at the end of the tax year, you're rubbing your hands together, you're thinking, it's time to invest, I got this. I'll jump on this Selfwealth Live thing. If you're new here, welcome. If you're a bit more experienced, welcome as well. And if you've been here since the beginning like me and Rob, thanks for sticking around. I'm sorry, I guess is the right thing to say. But I figured no matter what, new year, new me, so many people want a new portfolio. They're probably going to clean out some of the riffraff that's hanging around in there, some of those old ETFs and stocks that they've held for years. And now it's time to take it a bit more seriously. So what I've included on this page is basically my starter pack for anyone who is interested in learning about investing. And I do have a shameless plug down the bottom right-hand corner there for some of the Rask stuff. But I genuinely think that one of the best things I've been able to do is have the podcast and interview people and hear from these great investors and share that with everyone as well as my colleagues. But on the screen here, we can see that some of the resources that I use all of these resources daily, to be honest. We've had Gurav and John Addis from Intelligent Investor. Have we had Mark LaMonaco from Morningstar? We've spoken about Morningstar a lot. Bryson ran the guys Equity Mates, the Motley Fool website. Stocklight is an investing app where you can get push notifications. We've got the Ticker Terminal, which does all the data. Strawman is an investment club where you can sign up. I think they have 2 intakes a year, and you can share your research with people. It's pretty cool. So this is kind of like if I was investing in Australia and I only wanted Australian stuff, this is what I would look at if I wanted to learn about investing from the ground up. So I would highly encourage each and every one of you. Market Index is a great place to go for like really punchy news or instant like media releases and that sort of stuff from companies. So this is kind of like a starter pack that you could just go to these places and you could bookmark them. You could make maybe a tab in your browser or something like this where you have them all. Obviously, I used to work for the Motley Fool, so I was very lucky there. But all of these I read almost daily, if not weekly. So Great things there. If you use any other resources in Australia, I would love to know. And this is what I mean by commenting tonight. I would love to know what you use because it's a new financial year for me. I would love to know the resources that you're using, what apps you've got, what analysts you're following, all this sort of stuff, because this is the type of thing that we can do to help each other out on the show, including helping me out because I'm always on the lookout for these things. Okay, so before we get to the stocks, I've actually got 3 stocks that I want to share with you tonight. One of them you guys know, and the other 2 I don't know if anyone has actually heard of them. So that will be interesting. So the poll for investing tax return. What tax return? Exactly, Demod and Da Vinci. Yeah, you and me both. So okay, so Lynn Alden, the G says, I follow and use TradingView. Okay, yeah, great. A lot of people I know use TradingView. I don't use it myself, but Lynn Alden has come up a couple times. So great suggestion. Thank you. So I just want to quickly, before we get to the companies, go over this checklist. Some of you would have seen this before, but basically the way I think about picking companies and picking stocks, I'll make these a bit bigger. I wanted to try and squeeze them all into one page, but the way I think about picking companies and picking stocks is actually pretty basic. It's pretty similar to what you'll see most people talk about. I think it's not necessarily these dot points that do all the heavy lifting. It's what goes in to actually find the answers to these questions. So when I'm investing, I'm looking for 5 different things in the companies that I own. So I'm looking for companies with a strong competitive advantage. That's what we call a moat in investing. It's like it's this belief that some companies can defy gravity. And what I might do is I might actually expand this and get rid of this junk real quickly. And I'll show you what I mean. So obviously a moat is from a medieval castle. Think of the castle as the business, and the ring of water around the outside is the thing that protects it from competition. This one's actually got a bridge on it. Don't ask me why, but the bridge here is basically to kind of, with the example and the analogy, a lot of companies make mistakes. And when they make those mistakes, for example, they make acquisitions or they're too aggressive, what they end up doing is they actually lay down a plank like this for their competition to come across the moat and smash away their castle. So what we're looking for are companies that keep their moat in place and they widen it. So we can't just have companies that we think are great, like say Coca-Cola. I think I've got in from my hotel room. I actually probably got an overpriced glass of Coca-Cola here, or bottle of Coca-Cola, I should say. Coca-Cola is a great brand, right? So that's actually its competitive advantage. Another competitive advantage might be Facebook and what we call a network effect, which is the more people that use Facebook, the better the platform, etc., etc. That's another competitive advantage. And then there are things like switching costs. This is like a Visa or something like that. Like once you use Visa, it's very hard to switch if you're a bank or something like that. If you're a merchant or something like that. So these businesses get to a certain size and they dominate the competition. So in any case, that's the first thing that we look for, is we look for a business that has some unique attribute that makes it special. And the reason that we look for that is, and I'll move this out of the way, is because when you have a company that can win the market and the market is growing, you have what we call a gorilla. So a gorilla is a very rare type of company, and it's best described in the book Gorilla Game, which I've referred to quite a few times on the program. So Gorilla Game, I still think it's the best book for identifying. It's still the best book for identifying how to invest in fast-growing technology companies. It was written in 1999. I probably haven't come across a better book on it, but to be honest, after I read this one, I kind of stopped searching for other books because I was like, this is the one that's good enough for me. Like this answers a lot of my questions. But in any case, this book is great because it explains to you this chart here, which shows you that if you can find enough of these companies earlier on, and they are these gorillas, what actually happens is as the industry grows around them, they become more valuable. So say like Google Search. Google Search was a chimp for a very long time with Yahoo and other big competitors. But eventually it became number one. And then what happened is the internet expanded around them. So they were number one in a really big and growing industry. And so naturally, the blue shades here actually show you that as the company dominates from this dark blue section to the light blue, and it gets bigger and bigger and bigger, it actually takes more of the profits from that industry and it becomes more powerful. And what these little flow charts show you is that like you get bigger and bigger returns, but the company becomes safer and it becomes more dominant for a longer period of time because it is the biggest. Like if you think about it, when was the last time, Bing is a genuine competitor to Google search these days, but how often once you install Google and you use Google search, do you look for an alternative? For me, I haven't looked for years, to be honest. So for me, once you've chosen the player that you're going to play with or the company that you're going to use, the rest of it is kind of history. So what we look for are companies that have those strong moats, but they are also in growing industries, so structurally growing industries. And they must be in an important sector. The other things that we are looking for is this thing right here, is the management team. So at Rask, for example, we don't do it anymore, but we used to do gold, silver, or bronze for a management team. So we used to score them and we used to say, this is a gold management team, as in the best, silver, or it's bronze. And if it wasn't up to that standard, which is a very high standard, we wouldn't ever invest in that company. So we gave companies different scores depending on what we thought of the CEO and the board of directors and the management team. And finally, I'll just put an extra one in here, which is the business must be in our circle of competence. As we're going to talk about tonight, we're going to talk about a few different companies. I've followed these companies on and off for 5 or more years. Maybe one of them less than that, maybe 4 years. And I have to say that like it took me a long time to learn what that company actually did. So when we talk about circle of competence, we're talking about not investing in things you don't understand. Like a lot of new investors do that, and experienced investors do that, frankly. Like there are been a lot of businesses over the past couple of years in this technology craze and COVID and all this sort of stuff, where investors have just gone a little bit bonkers, to be honest, and they've ended up investing in things that, in my opinion, are not investable. So maybe they have an ability to understand that, but I definitely don't. Okay, so one final thing before we get to the companies. I think this is the final thing. Yes, this is the final thing. So I want to just mention something because it's the end of the tax year. If you're anything like me or probably hundreds, maybe tens of thousands, maybe even 100,000 other investors, you get to the end of the financial year and your portfolio is a mess with all of your trades and your costs and your tax stuff. These two apps here, ShareSite is the leader and Navexa is kind of the next one. If any of you use Paul, you've said, I just read your comment, wash your mouth out with soap for saying Bing and Google in the same sentence. I know, Paul, I'm so sorry. If any of you use ShareSite or Navexa, I would love to know if you do. Please comment in the chat because that would be really interesting to me to know which one you use and what you like about it. Both of these are not they're not trading platforms. They're ways for you to track your portfolio. So for example, with ShareSite here, you can hook it up so it connects to your brokerage account, or it automatically receives all the trades through an email, and it will track capital gains, income like dividends, all this sort of stuff. So you can do that, and you can make like tax time a breeze, to be honest. So and Benny uses ShareSite, Dale uses ShareSite, Nera Mac uses Navexa, Owen says that uses ShareSite out of the park. Oh, so smashes ShareSite out of the park. I think you're talking about Navexa. Jason, ShareSite. Paul, ShareSite. Martin, ShareSite. Michael, you're saying good reports with ShareSite to help complete tax returns. Yeah, so that's great. Thank you guys for sharing. So both of these apps effectively allow you to track your portfolio, and if you don't, if it's not really like that easy to set up, what you can do is you can actually, you know how you receive those, when you place a trade in your brokerage account and then you receive a message from your broker saying you bought Commonwealth Bank shares, successful confirmation or something like this. You can actually set up in your Gmail or your Hotmail or your Yahoo or whatever you use. You can actually set up an auto forward from your Hotmail or your Gmail, whatever you use, to a unique email address at ShareSite on Avexa, and they'll automatically receive that email, read the email that you've sent them, and then add it to your account. So they'll add it to your Navexa account, or they'll add it to your ShareSite account. So all of your trading and all that sort of stuff is automatically updated. It's a pretty cool tool, if I'm honest, and it makes life really easy. So Vigis says, I use ShareSite. Okay, so ShareSite still the winner here. Okay, so I just wanted to add this in because tax time is a mess. And I've got a photo of myself there. That's not good. It is a mess. And this software, I just wish someone told me about this sooner. It can also handle ETFs, by the way. So check that out. Okay, I think a few of you in the pre-chat of the live show did say something to the effect of, I think maybe Owen is going to talk about small cap shares. I think maybe someone said that. And you're right. I am going to talk about small cap shares. If you remember from last year's Selfwealth Live, and I'll bring this up really quick, tax return. Where was this last year? This one. So this one from last year was a pretty popular show. We talked about ETFs. We talked about where I'd invest if I had a tax return. And the reason that I said where I'd invest $3,000 last year is because last year the average tax return was around about that amount. And obviously, every time it comes around, you have a choice to make. You can either invest it, you can save it, or you can spend it. Or you can do a combination of those things. My co-host on the Australian Finance podcast, Kate Campbell, she always tells me something which is really important. And she says this to our community. She says, whenever you get any type of money, so whether it's a tax return, whether it's someone gives you money, or whether you have a windfall, or whether you have an inheritance, the really, really, really important thing to do is to have a purpose for that money. So some people will just receive their tax return and they'll go, oh, look, a tax return. Great. Some money. I've got, $3,000 or whatever you get. And then they just kind of just put it into consolidated revenue. So Financial Freedom says she's a legend and I've pre-ordered her book. That's great. That is so good. I'm glad to hear that, Financial Freedom. Yes, Kate is coming out with a book, long awaited, which is fantastic. It brings a smile to my face. So Rob, you did actually make a comment here, just going back a second. You said, I find my MyGov auto-fills dividends, so why bother with software? Fair enough, Rob. So there are a few reasons why you might consider the software. One of the things is performance reporting. The other thing is capital gains. So as far as I know, capital gains are not filled with ATO pre-fill. And I've actually heard of quite a few instances of dividends not being recorded accurately through autofill. So let me just explain what Rob and I are talking about. The ATO knows that you're investing, right? So with your tax file number, they automatically receive an amount when you do your own taxes that is called pre-fill, and that shows dividends and some other interest you might have received from bank accounts. But it doesn't include things like capital gains as far as I'm aware, and it doesn't include quite a few other things. So there are a few other reasons, but one big reason, Rob, that I think those websites are really, our Rob's from Selfwealth just said, MyGov missed nearly all my dividends. Yeah, and that happens. It's really common that the MyGov pre-fill service from the ATO misses so many dividends. And that's because the whole investing system is still really fragmented here in Australia. It's really hard to do the admin. And so I don't blame the supercomputer at the ATO, frankly. It's not its fault. What I would say is there's another really good reason to consider using that software that I mentioned before, and that's this thing. A lot of people start investing in shares and they kind of have you would know, the collector mindset, which is where they just go and, I'll buy that share. Oh, I'll buy that ETF. Oh, Owen talked about this on Selfwealth Live. I'll go and buy that. And what they end up doing is they become a collector, kind of like a hoarder. They collect things that they may not need and they have no clear strategy. And what ends up happening is it's 2, 3, 4, 5, maybe even 10 years down the road when someone goes, oh my gosh, I've got like 50 shares and 20 ETFs and I have no idea really what I'm doing. But more importantly, I have no idea how I've performed. The value of my portfolio has gone up, but is that just because I'm adding more money? So those pieces of software actually report your performance. And that is so important because then you can go, not just you, Rob, but anyone listening can go, hold on a second. Over the last 3 years, my portfolio has only gone up 2% a year, but I can go and buy this ETF and it's done 7% per year. Why wouldn't I just do that? And that's like a huge realization that so many people take so many years to figure out. So you don't have to use that software. I'm not incentivized one way or the other. But I definitely found that was a game changer for me in my investing, was realizing, hold on a second, I made that investment and it cost me this much in my returns. Really bad idea. What went wrong? Okay, so getting back to it rather than talking about that. So Owen said, I use Navexa for performance. I don't use it for reporting. That's what the accountant is paid for. Welcome to Perth, says Harpreet. Thank you. It's great to be here. Okay. Brandon, you said, what's Kate's book called again? It's called Buying Happiness. If you just Google Kate Campbell, Buying Happiness, Brandon, that's it. So, okay, here we go. So I actually said 2 under the radar small caps because there's 2, but I actually think 3 of them are under the radar. And so many of you will know that I like to invest in small cap shares, but I have a very, 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 very high risk tolerance, and a lot of people don't. So these are the types of things that probably only 5 or 10% of investors should actually consider, to be honest. So I will mention ETFs as well. I got a question today in a live program. I got a question today. Hey, Owen, do you still think the VDHG ETF, which is the ETF from last year's live, is still a good thing? And yes, I think this is a fantastic ETF for the long term. I think it's a fantastic ETF. So this is the VDHG ETF. Fantastic. But let's just let's just go from the top down. Let's look at the stock market's performance overall before we drill into these 2 companies. So here we can see, and I might just make the screen a bit bigger for my sake. I'll get rid of that junk just there. Here, what we can see is the performance of the major stock markets that most Aussies know over the past 5 years. So in this lighter shade of blue up the top here, we can see we've got, this is the NASDAQ. So this is the top 100 US shares, mainly the technology shares. We could do this with the S&P 500. In fact, why don't we do that? I'll do that in a second. But regardless, this is the US stock market. This one, the blue one. The yellow one is the Australian overall stock market. And the dark blue one are Australian small cap shares. So this is what we call the small ordinaries. You can't see it there, but it's behind there in that ellipsis. So what we can see from this chart is over 5 years, the US market has blitzed it. So this is like Apple, Tesla, Nvidia, Facebook, Google, etc. Right? They're all in there. Obviously, they're fantastic companies. In the blue, we've got like CBA, we've got Wesfarmers, we've got BHP, we've got Westpac, we've got NAB, etc. So that's in the yellow, the orange color there. So you can see it's done reasonably well. But one thing I will say really quickly is that this here is not including dividends. So that's something that I really want you to keep in mind, is this is not including dividends. If you included dividends, the return would be a lot higher. Okay. This one down here also doesn't include dividends. And keep in mind that US companies don't often pay as much in dividends. So this would be materially boosted, not quite to this extent, but close to. Okay. So what we can see, just broadly looking at this, is that the US has performed better, right? That's pretty clear. Like it's performed better. It's done very well. We can see in the ASX 200, the top 200 Aussie shares, it's also performed pretty well. But we can see that the small companies in Australia have really struggled. They were doing okay for a time, but then what happened is COVID hit, and then things got really kind of the washout of COVID, like higher inflation and those types of things. And this here is the perfect illustration of small cap companies, or small companies being risky. So I wanted to add this for 2 reasons. One, to show you the relative performance between US shares and Australian shares, but 2, also show that small cap shares can be risky. So we've basically got small companies, large companies, and US companies here. Okay, so let's drill into why I like small companies. Actually, no, before we do that, let's just go back to this comparison chart um, in Google. So what I'll compare it to is the IVV ETF, which is a wonderful ETF that we all know. And then we'll compare it to the small ordinaries. Okay, it's not coming up. ASX small ordinaries. I don't know if it's coming up. Okay, it hasn't come up. So we'll just compare these two. So we've got the ASX 200 and we've got the US stock market. This is the top 500 US shares, not the top 100, which are in the NASDAQ. And here again, we can see the US stock market has won well and truly. And so what I mean to say by all of this is that a lot of investors have said, well, the US stock market has performed extremely well over the last 5 years. Maybe it's time to look at Aussie shares. And so that's good. That's great. Let's look at some Aussie shares. But also, the small companies have performed really poorly. So maybe we should look at small cap companies. Now, why do I like small caps? Firstly, because not as many analysts are looking down there because it is riskier. Another thing is you find a lot of small businesses that are capable of long-term growth. Conversely, you find a lot of businesses that never fulfill that growth and you get very risky businesses. So it's really important that you have your wits about you before you venture down this alleyway and go down, right down the end towards the small cap world. And Paul, I can see you've said you love IVV at the moment. Yes, the IVV ETF, I do love it as well. And guess what? I got my tax statement from IVV Friday, I'm going to guess. Got my tax statement. So I got my tax statement, which means now I can do all my taxes. And I think most of you know this, but I also invest through my company, and my company owns the IVV ETF as well. So for me, it allows me to do both sets of taxes now, which is fantastic. Okay, back to this. So there are many reasons why I like small caps, and there are many reasons why I think they are risky. So when I talk about these companies, I really want you to keep that in mind. I really, really want you to keep that in mind because these are very risky businesses, and you should. In fairness, I do not currently own SmartPay. I do not currently own this one, and I do not currently own this one. These are just like positions for the watch list. If I was starting out today, I would not start with these. I would start with an ETF, like the one I mentioned earlier, or like the one Paul just said, the IVV. Kilua, you've just asked, investing through your company means you pay less tax. Actually, it's not that, Kilua, although I know a lot of investors that do choose a company structure for various tax-related reasons. Personally, I use a company because it's the company that I run, right? So I run the Rask Group company, and when I don't have anything left to do with, this is first world problems, but when I don't have things to do with the money straight away, I'll invest it. And so I'll invest it in shares. That's how that's why I do it. So there's no like, you got to be okay. Just really quickly, this is a digression, but I've seen a few questions come through on this. A lot of people set up companies to do their investing for them. You should get expert advice on that because there are some tax implications to doing it which are not always favorable. Sometimes it's good, sometimes maybe not so good. And so just get expert advice. Just speak to your accountant or speak to someone who knows these things. But for me, I have a company, and a company can open a Selfwealth account. There's no limitations on that. So why not? And so that's what we do. Yeah, same reason for you, Ali. Okay, great. So, okay, let's talk about these two businesses. This is a bit you guys want to learn about. Okay, let's just start with, say, Lavisa. So we had Gaurav Sodhi on the show not too long ago. I highly encourage you guys, if you are on, I get to see all the votes. Will you be investing your tax return? 50% say yes. You guys are wonderful human beings. I always knew that you guys were really smart, smarter than me. So Selfwealth, I'm going to butcher his name, Gaurav Sodhi. So we did a podcast not too long ago with Gaurav Sodhi, and Gaurav here. This was an absolutely brilliant chat. So I'm going to chuck this back in the conversation for tonight. And I'll say Lavisa. Now, Gurav came on and talked about this company called Lavisa, and Lavisa's found that all good Westfield shopping centers and so on and so forth, they typically occupy that crappy little store at the end of the mall, and they sell jewelry. They sell the jewelry that typically, I'm using a stereotype, teenage girls love it. Women tend to love it as well because, hey, I love it when I'm buying for my partner or for my friends or for my sister, because you can get cheap jewelry that looks just like the expensive stuff. And, it's a bit of fast fashion. So there's a bit of an ESG unfortunate reality to this. But at the same time, they're a really good business at designing cheap jewelry that can be worn for a few nights and then it goes in the drawer or something like that. A lot of people don't like this business because they think, oh, who would shop there? Or like, I don't understand it. But their value prop is clear and the business has been exceptional. And what I mean by exceptional, you can see on the next page here. So over 5 years, shares are up 81%. Over the full time horizon, which goes back to 2014, shares are up 800%. In that time, they've also paid out a stupendous amount of dividends. So you've got dividends and growth. Now, I highly encourage you to go back to the Gurav episode, but it was clear based on what Gurav said. Actually, it looks like it's performed well since then. It was clear based on what Gurav said in that episode that this business is high risk, which is automatically interesting to me. It's run or overseen by a guy called Brett Blundy. So if we go back up to my checklist, it's overseen by a guy called Brett Blundy. And he's a fantastic retailer in Australia, very wealthy now as a result. The business, this is where people fall down. Does Lavisa have a competitive advantage? If you have an opinion on this, please share it with us in the chat. Lavisa is a business that it's a retailer and sells cheap jewelry. So what's its competitive advantage? I believe Lavisa's competitive advantage is its ability to design, distribute, and stock shelves within a matter of weeks. It's the same competitive advantage that Zara, just outside my window here, has. Zara can ship clothes around the world in a matter of weeks. And what's really interesting about that is a lot of people underestimate like speed as a competitive advantage when they think about businesses. You don't think of maybe Domino's and maybe McDonald's at a drive-through. You think, wow, I'm glad I got that fast. I'm going to go back there. But when it comes to designing things, speed and time to market is really important. So that's what I think Lavisa's competitive advantage is. Is it in a growing industry? Well, not really, but it operates in markets that are huge. So Lavisa is now expanding into Europe. It made some acquisitions and the US, and it has huge overseas growth potential. Now, are shares fairly valued? Now, this is the thing where it probably falls down a little bit. Oh, and by the way, it's within my circle of competence because it's a retailer. I walk past them most days of the week when I'm in the office. And I understand that it sells jewelry, has to design them, so on and so forth. So are the shares reasonably valued? Now, this is where extra research, and if you go back to that chat with Gurav, you'll see and hear what he said. But effectively, the company's at about 750 stores now. Now, if you take a really optimistic view, again, really optimistic, and you look abroad, it has potential to have thousands of stores. And if it gets to that, obviously, we'll look back and we'll say, well, that was obvious. But if it doesn't get to that, it'll probably be overvalued. So that's the trade-off investors have to make right now. But I think it's a really interesting business that I've definitely got on my watch list right now. Like, frankly, after it got beat up, the share price got beat up not too long ago because everyone was so scared about the quote-unquote pending recession. Retail shares got sold off. And to be honest, they could keep getting sold off. I think there was a great question a few weeks ago from Genevieve about this. But at the same time, you don't always get an opportunity to buy a really good brand, the shares in the company, for less than you think they're worth. It's actually really hard to find that. You have to invest when there's uncertainty. CP, you've said, not in my area of competency, happy to give it a pass. Ali, you said, I think the better argument you guys made in your video was that it has a much lower overhead. Yeah, exactly, due to the store locations and staffing. So that's a really good point, Ali. Thank you for bringing that up. So another competitive advantage that Lovisa tends to have over competition is it tends to have stores in places where the rent is cheap because they're willing to have those crappy little stores, and they're also occupying the really ugly type of stores. So the ones that other brands don't want because they can't fit their stock in because it's like an L shape or because it's a triangle floor plan, Lovisa will take them. I'm thinking about one in the city of Melbourne for me. This one right here at Burke Street Mall. It's a tiny, tiny, tiny little space. And if you go in there, because they stock jewelry, you can fit about 500 pieces of jewelry in one little drawer. So they can put it all in there, and they've got it all. They've got it all set to go. I saw a comment there, a bit of it. Emma, you said costume jewelry is the term. Costume jewelry. Well, fantastic. Thank you for that. So, Roflux, you said, this seems like a boomer stock. I feel like an online focused player could take it down. Roflux, thank you. There have been a lot of businesses that have challenged Lovisa over the years. And if you remember old brands, I think it was Diva. I think you remember that. But if you look abroad to overseas, Lovisa's actually eating the cake as far as eating their cake, as far as I can tell. Now, I could be wrong, but Lovisa seems to be eating their cake. So that's really interesting to me, where I see like a existing like net market getting kind of, I guess, shown how it's done by a new player. That's really interesting to me. It means they must be doing something. G'day, Roger. Welcome to the live show. Anthony said, I walked past Chadstone's store after that show. Anthony, tell us, you walked past Chadstone. So Chadstone's apparently the fashion capital of Australia. What was the store like? Please tell us. Please tell us. What was the store like? Is there one in Brizzy by any chance? Interested to have a look at it, says Patrick. That's a good question. Let's go back. I don't actually know that. One of the best things you can do with your investment research, guys, and you should probably all get this by now, is actually go and try the product. The next company that I'm going to talk about, I'm going to ask for some feedback. Looks like there's a ton, as they would say, up there, up in Brizzy, up in the old Bris Vegas. Look at that, right in the middle, right in the big smoke. You've got the Myer Centre. You've got Clarendale or Carindale. Geez, I'm not really good. I don't even want to try and pronounce that one. Brizzy Airport. There you go. I'll try and find all. I'll have a look at the Brizzy Airport one up when I'm up there in 2 weeks. But yeah. So what I would say is, please have a look at these stores. If you have any feedback, let me know. So Anthony said Chadstone ain't cheap, but it had people in 6 p.m. Thursday night. Yeah, great. Okay. So I can see a lot of feedback here. Like Lovisa's more for women. Great. Roger said Lovisa in Singapore is in the upmarket Orchard Road malls. Interesting. Okay, so I'm going to move on to the next company in the interest of time. Now, if you thought that company was kind of risky, the next one's even probably riskier. So, and then the last one's the riskiest, depending on how you think about risk. Okay, so the final, the second last company, I'll get rid of that, is this company right here. If there is anyone who knows this brand, can you please comment in the chat? Like, I would really appreciate this. If you know this brand, not just as an investment, please comment in the chat. I'm particularly talking to you, business owners. If you have seen this before, please let me know what you think. Nadine, you said, my 10-year-old is mad for Lovisa, as are all of her friends. Yeah, my sister is mad for Lovisa. So, share success. You've said, Owen, how many stocks do you own? Would you consider revealing your portfolio? I don't want to reveal too much share success, but what I can say is a few things. One is all of my ETF portfolio is always revealed to our members at Rask. Second of all, my two biggest holdings are Xero and Pro Medicus, and none of that in any way comes close to my shareholding in the business that I run. So I hope that adds some context to your life. But there will be more. I'll have more news for that on that in the future. Share success. So I will have an announcement, not necessarily on revealing my portfolio, like surprise, and then we, there's a balloon that pops and all of my stock ticker symbols come flying out of it. Nothing like that. But yeah, there will be something in the future. Okay, here we go. There's some good comments. Here we go. So Patrick Swift, you have heard about SmartPay. Greg, never heard of them. Pearly Nari, I think. Sorry, Pearly Lynn Ray. Pearl Lynn Ray. I think I got that right. Maybe right. You said you've heard of SmartPay. CP has heard of them. What else have we got here? CP, you said SmartPay. Again, not sure on pricing power and how much defensibility it is. Very cutthroat market. Okay, yeah. So Dale says I'm with Chop. Okay, so anyway, this company, if we go back to it, this company, SmartPay, if I go to its website, so this company does something very, 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 very simple from the outside. And you might be like, well, that doesn't make any sense. So when a company comes along and everyone seems to say, hold on a second, that doesn't make any sense. Why would I invest in that? And it's reporting bigger and bigger and bigger profits, and its customers are saying, this is great, this is great, this is great. I really do pay attention. And so once I heard about this company called SmartPay, which just does these terminals, right? Like these terminals right here. I thought, I've got to go out and try and find businesses that use them. And what it is, it's very simple. So if you've ever had a surcharge added to your restaurant bill or your mocha frappa latte that you buy from Starbucks or whatever you get, maybe it's turmeric latte, who knows, you'll see a little surcharge go onto that. And it might sound simple. Well, yeah, just add 50 cents onto my cup of coffee. Sure, I'll cop that. No worries. It might sound simple, but that is actually a very technical thing to do. So for a business and the FPOS terminal provider to calculate on the fly what the surcharge should be from Visa, MasterCard, the credit card company, all this, it's very, very hard to do. SmartPay can do that instantly. And so the benefit is purely to a business owner. So imagine for a second that you have, you have a business owner who sells retail goods, like even like Lavisa. Lavisa is probably a bad example, but imagine you've got a store like Lavisa, but not as good. So say it's like Jill and Bob's fashion outlet or something, right? Now that company, that retail store probably has a 5% profit margin, like really low. Like it only makes a 5% profit margin, meaning if it has $1 million of sales, it only brings home $50,000. Now, imagine if all of those payments were on a card. And then imagine that I come in and I've got like an Amex or a Visa or a credit card, right? If I tap my credit card, it costs more to the business owner to accept that. And so at the end of the day, what ends up happening is the business owner loses. And so if SmartPay can come in and say, hey guys, we got you. Hit the microphone, sorry. If they can come in and say, hey guys, we got you, we'll just add that little bit on, their profit margins are dramatically improved. So what we see from SmartPay is a very clear valuation proposition. So investors think, well, geez, okay, it's not really that good of a business, but it keeps on signing up these customers and the share price keeps going up and up and up and up and up. And so you can see from 2019, it was at 17 cents, and then recently it's $1.50. So it's almost a 10 bagger, and that's in about 5 years. So obviously people are thinking, well, why is that happening? And I believe it's because the business has a very, very clear message to store owners and to retail stores. Just come with us and we'll take care of that little thing for you. And don't worry, customers will pay. I'm going to try and find, I think this might be it. They do this chart, which is a very neat little chart, and they do it all the time. And no doubt now when I'm looking for it, I can't find it. Here, I think they did it in April. Yes, here we go. So this little chart they publish frequently, and this shows you it's a really simple business to understand. Put terminals in the market. Each terminal makes a set amount of money. Like every percentage that goes through, SmartPay will add every dollar that goes through, SmartPay will add an extra little bit here or there, and you can see the number of terminals keep going up, and the monthly revenue keeps going up. So this business is what we call it's crossed the chasm. It's reached profitability. It's past the point where people didn't understand it and people doubted it, and now it's at a point where it's well and truly kind of shrugged off those concerns. Okay, so there were some questions here. Chop. I said my biggest holdings are in Zero and Promedicus. Sorry. Okay, so Paul, you said heard of Laserbond, read about them, but haven't got any further. I'll get to that in a sec. Greg, you said with SmartPayler and similar companies, there is a need to consider legislative changes that may affect their options. Absolutely. So SmartPay's kind of in this unusual spot where it's a heavily regulated industry and you've got juggernauts like Visa and MasterCard. So I'll get to that in a sec. I hate these FPOS companies pushing 2% onto me after the sale. Anthony, it's a pretty normal thing these days. And if anything, I think the real risk is that people realize how much Visa and MasterCard are charging people, because it's Visa and MasterCard and the credit card companies like your Amex, your Citigroup rewards, all those types of things. Here's an interesting, actually, I'll bring it up on the screen. It's much easier to show you. One of my old analysts wrote about it. Here. Patrick was as a former analyst at Rask, and he wrote about this company years ago, or not that long ago, 2021. We were looking at it long before then. Okay, so if you look at this very simple chart here, what it shows you is that when you get that, for example, Anthony, 2%, right? That's called a merchant fee. And you can see that the issuing bank of the card, so say, for example, I tap a Commonwealth Bank credit card. It's actually Commonwealth Bank that makes most of the money. After that, it's Visa and MasterCard. And then there's the switching network, so it might be like FPOS or something like that. And then there's this other one, which is the acquiring bank. So in effect, you have all these different fees that bundle in there, and they all mix depending on what cards are tapped, what the purchase is, what the merchant or what the seller's arrangement is, and blah, 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 blah. But what you can see here is it's actually not the FPOS terminal's fault. It's actually not their fault, and it's not the business owner's fault. In my opinion, it's actually all these credit card companies that get in the middle and have to support their rewards programs that they have to foot the bill for. And so that's I hope that illustrates where it comes from. And as someone who coaches a lot of small businesses, I've got to admit that I think these terminals are a great thing, because I take the other side where I'm like, I see so many of these small businesses struggling. This is a really good way for them to let everyone know what it really costs. So this is not the business that will let you use your mobile phone as a transaction terminal, Paul. So there's a lot of competition around SmartPay, and as many of you have said, there are a lot of risks. So when it comes to, just quickly, this checklist, SmartPay falls down. It's not clear what the competitive advantage is. The management under Marty Pomeroy is exceptional, in my opinion. It's a business I can understand, although it took me a few months to get used to it. It's in an industry that is kind of growing, even though we might not think about it. It's actually a business that has always been quite reasonably priced. More recently, it's got more expensive, so it's probably on my watch list for now. And probably if it starts to pull back, it's one thing that I would very much like to take a second look at. And so it's a really interesting business, and it ticks most of the boxes, just not all of them. And what I find when a company doesn't tick this box is you have to be careful, because what we basically have assumed is that when you find a company that ticks all the boxes except one, my take is this: you should be there for a good time, not a long time. Meaning, it's the type of business that if you do own it, you are fully aware of the risks, but you're also aware that you might not, it's not that bottom drawer type company. Okay. So I can see, so I can see a bunch of comments that have come through. I can see, Ali said, I think I once had a 50-cent surcharge for tapping an $8 car park charge. So that's a really interesting thing. So, for example, Visa and MasterCard to accept online payments or Stripe or whatever those, they charge a minimum of 50 cents a lot of the time. Oh, sorry, 30 cents. So some of them will say 30 cents plus a percentage. So something to think about. Okay. Is there, so do all banks charge the same interchange fee? My understanding is no, is the answer to that question, Klua. Okay, so final company that I'll mention here, and this is definitely the highest risk, but not because of what you think. This is a business that it's called LaserBond, and it's a business. I did an interview with the CEO, which I will share in the chat now. I'll do LaserBond CEO interview. I'll just pop that in the chat there in very bad English. And it's a tiny company that's very hidden from view because not many people want to go down to that part of the market. There's not many shares available to buy, so that's another very important risk to consider. It might be very hard to buy shares and it might be very hard to get out. But there aren't many companies. When you go through that 5-point checklist that I talked about before, there aren't many companies in Australia that can tick all those boxes. And then when you find them, oftentimes there's something about them that make them hard to invest in. So either no one wants to sell, or perhaps there's not that many shares available, or perhaps they're overvalued, or whatever. Like there are so many reasons. That's why all the really good companies in Australia have super high valuations, whereas the ones in the US don't. It's not because the Australian shares are better. It's because there's fewer really good companies for us to invest in, and we have a huge superannuation system, and everyone wants them. Whereas in the US, there's 10,000 different companies. So with this company ticks the boxes for one really important criteria for me, which is the management team. The current CEO, Wayne Hooper, has been with the business since the 1990s, is my off the top of my head understanding. And what does LaserBond do? So just really quickly, what does it do? Just to try and help people understand, because I think Paul and others might have got to it and thought that doesn't make a lot of sense to me. So when you see a big piece of heavy equipment, like say this thing right here that is working on a railroad, or like maybe it's on a sugarcane track, and let's say you look at a big piece of steel that you need for your factory, something that might be worn down a lot. What LaserBond does, and you can see the image. I've actually seen this laser in real life. This one right here. I'll zoom in a bit. This one right here. And what you can see it does is it actually uses the laser to repair the surface. So they call it surface engineering. So imagine you have one of those big trucks that BHP has in a mine in WA, and it's got giant wheels, and some of the wheels start to wear down, like the bearings inside of it. You can take it to LaserBond and they'll repair it. LaserBond says it can repair these types of products to up to 20 times the original strength. So if you're planning to use the truck again, you'd be much better off getting it repaired, and it's good for the environment, than having to buy a new one. So LaserBond's customers are not, in this example, BHP. The customers are actually the services companies, the mining services companies. And it's basically a family-run business. Wayne's brother started it many years ago. It pays a small dividend. It's expanding overseas, but it's very risky because it's so small. So that's probably all I have time to say. Stuart, you're here in the chat. It's great to have you with us, Stuart, tonight, who I know, have a very, very deep and vast knowledge of the mining sector, particularly here in WA. Very well known in mining. That's good to know. Are you kicking your desk, Owen? Oh, yes, I must have been knocking it. Sorry, Peter. Sorry for that. Okay, so Paul, you said, I know and understand what they do. However, they don't align with my investment priorities just yet. They are on my watch list, though. Geez, I sound all professional. That's good. So apologies for knocking the desk before, but yes, I was. So this is a really interesting business for me. If it's a family-run business, shares seem reasonably valued if you can get a hold of them. It's, as far as I can tell, like we never know for sure, but as far as I can tell, it's probably the leader in laser technology. And how do I know that? Is because it actually makes the lasers for other engineering companies in the United States and overseas, because they don't have them. So it actually makes the machines and sends them to people that probably businesses that probably would be considered competitors overseas. It also has a very deep academic research relationship with universities here in Australia. It has its own laboratory where it tests how good its equipment is versus not competitors versus the different standards. And I have seen that. What else? The company is in a growing industry because all of the mining services sector is looking for ways to decarbonize and look for alternatives to just scrapping it and starting again. So CP, you mentioned LaserBond does seem cyclical. It is, so it does move around a bit, but it's also a bit counter-cyclical too when you think about it, because instead of buying new, like say if commodity prices fell, miners are like, oh no, I need to save money. Well, you might just go with repairing something instead. Okay, so we've come towards the end of the show. I've just got a couple more things to do, a bit of housekeeping. First of all, something that I would love to share with you is in the chat. This is from both Rob and I. Quick survey, we'll say. This will really help Rob and I out. I've done a comment in the chat. It's called Quick Survey, and it's got a linkage there. So if you take that link and you click on it, this is an anonymous survey. We're not taking your birth certificates and credit card at this time. And according to this app, it only takes about 45 seconds. This actually helps us understand how we're doing. So if you go through this survey, it literally only takes 45 seconds. And you just go through it. You tell us broadly what your experience is so we know what topics we should be focusing on, how old you are. I'm just selecting random things. How often you trade in an average month. I don't know, just selecting some numbers. And how you would rate the show. So if you haven't done this survey before, we did it last year. And I don't want to taint the survey, but let's just say it was to the right-hand side of these numbers. Nudge it right up there to the right-hand side. So go and check it out. And the last question, as we can see, is the most important. I'll just keep on going. I'll just pick a number. Keep going through this. The final question is by far the most important, and this will be revealed next week in Selfwealth Live. The answer to the community's question: can dogs look up? And I've been struggling over this for many, many years. And the best response that I have to can dogs look up is only if you hold them upside down. It's not something that I guess an amateur should try at home, but it is a big deal. Can dogs look up? I think we will be able to tell you next week when we share the results of this survey. So please take a moment to fill that in. And don't forget a few things. We've got beta shares. The mighty beta shares. Is it beta shares? Beta shares? Maybe we can ask them next week. Beta. Who knows? We'll ask them next week. We'll talk about all different matters of ETF portfolios, how to create an ETF portfolio, how to analyze an ETF, how to basically like rejuvenate your portfolio if you're feeling like it needs something else. And we've got 4 different experts coming on the show. So it's going to be a very diversified. We've got a chief economist. We've got one of the co-founders. We've got one of the head of investment strategy. We've got, I think it's head of marketing or something like. We've got so many great people coming up from Beta Shares in the month of August. So please stay tuned for next week. Now, I thought on tonight's show, we're talking about investing. We're talking about, investing right now and what you do with a tax return. And what that typically means for a lot of investors is they end up just picking the thing that looks like it's done well recently. Oh, that's gone up. Oh, look at this. Sounds great. Oh, AI, artificial intelligence. Wonderful. Let's invest in that thing. And then only to find that everyone was wrong. And in 6 months, really, that AI thing, it really didn't make that much of a difference. And all those companies that promised AI really aren't AI companies. Or like some of the lithium companies, not to name names. But there's this fantastic quote from Stanley Druckenmiller, a legendary trader, if you will, who said, the crowd is usually wrong on the market. Now, if you're new to investing, you probably don't understand the subtleties in this quote. The crowd is usually wrong on the market. So a lot of people assume when someone says the crowd, they're talking about the market. the market is wrong, therefore the crowd is wrong. But what tends to happen in investing is when we talk about the crowd in this instance, what we're talking about is things like the investors that you associate with, the media, the headline writers of the newspapers. The crowd and what everyone seems to think is important is usually wrong. And I'm always I always bring up the quote of Jason Zweig. I'm paid an annual salary to write the same thing 250 different ways every year, and that's because the good advice doesn't change. So thank you, Benny, for taking part in tonight's show. Thanks, dudes. You said that's no worries. William, you've said, is the show you did today at 3 p.m. available? The show with the Australian Shareholders Association. I couldn't get in. Too many participants. Yes. For those of you that don't know, I ran a live show today for the Australian Shareholders Association, and I forgot that Zoom has limits. So that was my mistake. Unlike here on Selfwealth Live, we can have thousands of people tune in live and it's fine. Not with Zoom, as it turns out. So I do apologize, William. There will be another one next week. So the next week, there will be another one. So I apologize. So keep an eye on your email. I sincerely apologize. That was my mistake. So CP says, survey done. Last question is the best. Well, thank you. Thank you for doing that, guys. Rob and I put a lot of time into that last question. Beta in Oz, beta in the US, says Financial Freedom. Well, thank you for that. So before we go, this is a message from Rob. Anyone who had trouble entering the competition today, feel free to email me via marketing@selfwealth.com.au. That's marketing@selfwealth.com.au, or slide into the DM. So he's talking about the direct messages that are available on the Selfwealth website. It says like support in the bottom corner, I believe. You can click that, or you can just comment on the video if you're watching this back. So please take a moment to fill in that form. It's actually it takes 2 seconds, particularly if you're already a Selfwealth customer. I mean, you're a bit crazy not to fill it in because you go in the draw to win. You've got some ideas tonight. What's important in a portfolio? Dividends, long-term growth, franking credits, winning $2,000 of a beta shares ETF. Who knows? Say whatever you like in there. So I really do appreciate you guys taking the time to join us tonight. On behalf of Rob from Selfwealth and myself, Owen from Rask, we'll be back next week, same time, same place. Maybe not the same place, similar place, different URL, but the same YouTube channel. So 6 p.m. Eastern time next week. Bye for now. Thank you, everyone, for attending, and great questions. Speak to you soon. Bye for now.